Patience is a virtue and also one of the three key tenets in our investment philosophy. We believe that investors must be patient and present in their investments to benefit from the long-term power of compounding. Let's take a look at a few examples. This chart here is looking at over the last 20 years. The scenario is initial investment of $100,000 invested into the S&P 500. That black line there is showing that this investor remained patient and present in their investments throughout all of the volatility over the last 20 years. The second example is showing that the investor went to cash for 1 year to avoid more potential losses during the peak of the great financial crisis. And then the third scenario is that same investor not reinvesting a year later and remaining in cash. You can see that change in value from 2003 to 2020 is about $300,000 from that initial investment. Comparatively, had that initial investment been $1 million, the difference in value would be about $3 million today. Now we can look a little bit more recently, zoom in over the last 5 years, just going back to 2018 with that same scenario and only go into cash for 1 month. So only being out of the market for 30 days during the height of the volatility during the pandemic when the global economy was shut down. Had you gone to cash, the difference between your annualized return would have been 7.2% compared to 11.58%. The numbers aren't as big because it's a shorter amount of time, but still the difference in return is vast by not being present and patient in those investments. Now you may look at this and say, okay, I know that once I start investing, I need to remain invested and remain patient. But I don't know if the right time is now to start. Well, that's an opportunity cost that we think could be potentially detrimental. Let's take a look at an example of, bad luck investor that has the worst market timing. That bad luck investor invests in October of 2007, right before the great financial crisis. Even then, had they invested at that time, they would still have averaged a 9.1% annualized return from the S&P 500. So even with the worst possible timing, that's still a much higher return than what they would have had remaining in cash. And even looking back to February of 2020, so going through the pandemic of the global economy shutting down, going through 2022, which was one of the worst market years since the 1970s, the investor would have still averaged a 10.32% annualized return on their investment. So yes, it is important to be patient in those investments, but it is also important to start now and develop your plan. We can help you do that. If you have any questions, please reach out to us via info@crestmontpw.com or visit our website at crestmontpw.com. Thank you.